My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll go and make friends. I'm just hoping you save some money. My job, not just to entertain, but to put it in context. Call me, 1-800-743-CNBC. Tweet me, Jim Cramer. What can I say about this market? The inputs today, they're just plain bad. You can't have oil creeping up every day. You can't have mortgage rates about to climb again. You can't risk having the Fed look the wrong way if things are getting weaker sooner than expected. But how terrible are the inputs really? Should stocks have been down so harshly with the Dow slipping 397 points, S&P losing 0.72%, and the Nasdaq plunging 0.95%? The answer kind of is yes, but not because the inputs are all that terrible in reality. What drove stocks lower for the most part wasn't even consequential. If we get weaker job growth in Friday's non-farm payroll report, the narrative will shift again as everybody starts betting that the Fed will quickly cut interest rates to stem some sort of, hard landing. Long-term rates, which have been climbing higher since late last year, will probably top out around these levels, and the 30-year 4.5% really isn't even all that high historically. What really matters is that we haven't had a sell-off in so long that we've forgotten how to handle it. So tonight, let's go over the rules of the road. Yes, road rules for dealing with a sell-off. Well, what do you have to do first? You have to identify the real reasons for the decline, not the headlines. Now, we know that interest rates have gone up. We need to decide whether the move is significant. The answer to this historically is that this kind of move typically doesn't do much damage to the economy, and therefore not much to earnings, which is what we focus on in Mad Money. Sure, there's some weakness. As Paychex told us in the release today, something will plumb with them later on tonight. And I quote, the softening in hiring we started to see in the second quarter continued in the third quarter. There's more choppiness in hiring across customer segments and industry now. End quote. Worrisome? Only if you don't read the next line, which is, quote, our clients tell us they still can't find qualified employees and are not willing to hire just anyone at higher wage rates, especially in areas with minimum wage increases and aggressive legislative changes. End quote. What are we going to do with that? I mean, California mandated a higher minimum wage. Naturally, that's going to cut into hiring. And it is harder to find qualified people. That's okay. Nothing new. Next. Tesla's numbers were weaker than expected. I mean, much weaker. 387,000 vehicles when we expected them to sell more than 457,000. That was their biggest estimate miss in 7 years. And their first year-over-year decline since 2020. Tesla's a headline grabber, though, isn't it? Always will be. But let's unpack this. We know that there's been an awkward pause in electric vehicle buying in our country. China's hurting with real price cutting in the EV market. Berlin's been disrupted by sabotage. To me, this is simply par for the electric course in terms of America. We can blame higher interest rates and weakening economy, but honestly, I think the country's turn on EVs for now. It's like everyone who wants one already has one. Tesla's simply feeling what GM and Ford were feeling, okay? The real problem with Tesla is that it turns out to be a mortal car company and not an immortal tech company. Third issue is PVH, the big apparel company that's behind Calvin Klein and Tommy Hilfiger. That gave us a terrific number, absolutely. But then it jarred us by talking about a slowdown of some significant proportions. A forecast that caused the stock to drop 22% today. Now, when I checked the report, though, it was about weakness in Europe. And we're not going to extrapolate from Europe to the United States, where business remains much stronger. I said in our game plan last Thursday that the apparel stocks were coming in way too hot going into PVH's quarter. Well, that sure turned out to be the case, huh? But I don't have a solid read-through to our country. And then there's the weakness in the health insurers. Wow, Humana off more than 13% today. United Health down over 6%. CVS, which owns Aetna, shredding another 7%. Bad for the consumer? No, hardly. I mean, the Biden administration just decided not to give insurers a bigger rate increase for their Medicare Advantage plans. If the government had sided with the insurers, now that would have meant horrific health care cost inflation. Instead, it's good news for most Americans, even if it's awful for the managed care industry, and it is awful. Oil, tough, because it translates immediately into higher prices at the pump. That's why the refiners were so strong today. But don't forget, natural gas is also an important inflation input, and it's still trading at multi-year lows thanks to a supply glut. While we don't fill our cars and trucks with natural gas, we do heat our homes with it. So call it even, or at least maybe more even than people realize. To take it all in, we've got higher rates, but the impact on the economy is not profound. Meanwhile, the impact on the market is what you usually expect. People pay less for stocks when rates go up. We just kind of forgotten that happens. Next item in the sell-off playbook of our checklist, road rules. Has this pullback created any buying opportunities? For that, I perused the bottom 50 performers, the S&P 500 today before it came out today. And the biggest decliners, well, I wish I could say found something to buy. You know what? My investing club colleague and senior portfolio manager, Jeff Marks, and I did a special video for club members this afternoon highlighting the opportunities we're looking at and what we're near pulling the trigger on. But we would need more follow-through tomorrow to make that happen. Some of our stocks were down, but not enough to make a difference to our cost basis, meaning what we've already paid for the shares. I have no desire to buy the health insurers when you get a stock shock verdict like they got for the administration last night. The analysts haven't even had time to get their acts together and do some downgrading. I bet you that's tomorrow's business. If you're inclined to bottom fish, that's the better opportunity. How about this retail off PVH? Remember, PVH was weakness in Europe, not America. The American apparel company stock most down today, VF Corp, but that's challenge maker of North Face. Well, 30% of its products are sold in Europe. You can't touch it. I do have my eye on TJX. Would be a great opportunity if we learn that PVH is suddenly going to start dumping inventory, or if clothing company Express might file for bankruptcy. However, PVH said that inventories were lean, so the off-price chains won't be able to sweep in and pick up the merchandise at the cheap. Home builders did get rocked by higher rates. That always happened. Last night, I mentioned that they're prolific buyers of their own stocks on any kind of rate weakness. But I'm hesitant to recommend a Lennar or D.R. Horton 3 days ahead of the big unemployment report. Hey, maybe Monday. Finally, what I'd look at is a sell-off in special situations. Last night and this morning, we huddled with GE Vernova, the power company that just got spun off by GE. It's the energy transition company with natural gas turbines and wind and software that will help upgrade the power grid so it can handle all this new electrical demand that comes from the data center. I thought Vernova seemed terrific before a bizarre late-day sell-off. More on that later. Now, let's go full circle in this sell-off. First, some perspective. We have to expect a 10% pullback every 2 years on average, according to legendary Peter Lynch, who used to run the Magellan Fidelity Fund for Fidelity. We sure didn't get that right. Second, we didn't see many stocks that were knocked down as part of an overall move in the S&P. Instead, we saw specific pockets of serious weakness. Finally, don't forget the market was overbought coming in on the S&P oscillator that I always rave about. Special deal for any CNBC investing club member who wants it. That means we were due for a pullback, and given that it's still mildly overbought at 2.62%, 2.62 at the close this evening, well, the move might not be over. Bottom line, after a day like today, all you can do is patiently hunker down and wait for lower prices. Somehow, I think we'll get them. Brian in Maryland. Brian.
Hey, Maryland, booyah to you.
Booyah, right back at you, Brian. What's going on?
Hey, I have a question about VRT, Vertiv. With the new NVIDIA AI chip requiring water cooling, and Vertiv specializing in water cooling data centers, do you think that Vertiv will become the next supermicro computer?
Well, here's the problem. Vertiv did anticipate went on with NVIDIA. That's why the stock is up 60%. It does have the legendary Dave Cote as chairman, but I do want to see if it can pull back a little because it's been a straight line, and straight lines do concern me. Let's go to Howard in Maryland. Howard.
Booyah, Jim.
Booyah, Howard. What's up?
Jim, first, I'm calling from the home of Francis Scott Key and the Star Spangled Banner.
Wow. I hope everybody's doing okay there.
UAA, Under Armour, will it become a merry-go-round stock, or will it ever prosper once more?
Well, I'm always happy to have Kevin Plank on, but it does seem that that's a cutthroat business. And we know that, look, you got Hoka with Deckers, you got Nike not doing well, you got New Balance. It's a dog-eat-dog world that Kevin finds himself in, and that's a tough situation for anybody. Let's go to Kevin in New York. Kevin.
Hey, Jim. Thank you for taking my call. Wanted to get your take on Verizon. Been holding it for a couple of years. I'm at the break-even point. What do you think about its future?
I think Verizon's actually getting better. I had been concerned for a while when the stock was at 8% yield that maybe something might be wrong, but no, the company's pulled out. It was just a couple of things that were dogging it, and I think it's a good situation to buy a 6.25% yield with a stock at 42. I like Verizon. Right? Today's sell-off might seem like a perfect opportunity to buy, but I want you to be patient here. I think there are even better prices waiting for us on the horizon. Remember, lower prices are better prices. So Mad Money tonight. The price of cocoa is going absolutely loco. So what are the technicals saying about the future of this hot commodity? And, of course, read through to Hershey. I'm going off the charts to find out. Then Paychex is out with its small business survey tomorrow, and we're getting an exclusive preview tonight on the state of the backbone of our country. And the new GE is here with the industrial kingpin breaking up into Vernova It's GE Business, it's called GE Vernova, and GE Aerospace. So where do I come down on the two stocks? I'm breaking it all down. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.